Hello everyone. Today we would like to present our financial report entitled Financial Management Analysis of Corporate Financial Performance, a Trend and Comparative Study of Public Bank and Bank Islam Malaysia Berhad. For this project, we analyzed the financial performance of both banks over a 5-year period from 2021 to 2025. Our analysis focused on 4 main categories of financial ratios, which are activity ratios, liquidity ratios, leverage ratios, and profitability ratios. Throughout this presentation, we'll compare the performance of both banks, discuss the key findings from our ratio analysis, and conclude which bank demonstrated stronger financial performance during the study period. Without further ado, let's begin our presentation. Before we move forward, I would like to introduce myself. My name is Nabrili Evanisterin from BA 2621A, and here are my group members, Cheryl Divine and Nur Nasrina. Before we begin discussing the financial analysis and company's background, we'd like to briefly share how we carried out this project. First, we went through the process of selecting a suitable company for our analysis. Since this assignment requires a comparison between 2 companies in the same industry, we decided to focus on the banking sector because financial ratios are widely used to evaluate banks' performance. Next, we chose Public Bank Berhad and Bank Islam Malaysia Berhad. We selected Public Bank because it is one of Malaysia's leading conventional banks with a long history of stable financial performance. On the other hand, Bank Islam is the country's first Islamic bank and represents the Islamic banking sector. Comparing these 2 banks allowed us to see the differences between a conventional bank and Islamic bank while analyzing the same financial ratios. Finally, we gathered information mainly from the bank's official annual reports from 2021 to 2025. These reports provided the financial statement and other information needed to calculate and compare the financial ratios used in our analysis.
Public Bank Berhad is one of Malaysia's leading banking groups. It was founded in 1966 by the late Tan Sri Dr. Teh Hong Pyo and officially began operations on the 6th of August 1966 in Kuala Lumpur. Just 1 year later, the bank was listed on Bursa Malaysia, marking an important milestone in its growth. From the beginning, Public Bank positioned itself as a bank for the people by making banking services accessible to the general public. Over the years, it expanded beyond traditional banking to offer a wide range of financial services, including Islamic banking, investment banking, insurance, and unit trust funds. Today, Public Bank is well known for its strong retail banking business and continues to uphold its core values of efficiency, innovation, integrity, excellent customer service, and sustainable growth.
Bank Islam Malaysia Berhad is an Islamic bank based in Malaysia. It was established in July 1983. Bank Islam was established primarily to address the financial needs of the country's Muslim population and expanded its services to the broader population. The creation of Bank Islam can be traced back way before the World War II, where Muslims in the country were already looking for an alternative financial system that would comply with the Sharia requirements. It was not until 1969, however, that the Pilgrim Management and Fund Board, also known as Lembaga Urusan dan Tabung Haji, was established as one of the first Islamic financial institutions, primarily to encourage savings and investments among the Muslims and help depositors perform Haji. Now let's get started on liquidity ratios. Liquidity ratios measure the liquidity or availability of the firm's liquid resources to pay current and maturing liabilities on time. As a basic rule, Higher ratios are better as they represent higher ability to pay. Although excessive liquidity may indicate too much investment in current assets, this indicates lower risk of technical insolvency, but may lead to lower profits as investments in current assets are not as productive as compared to fixed assets. Now let's get started on liquidity ratios. Liquidity ratios measure the liquidity or availability of the firm's liquid resources to pay current and maturing liabilities on time. As a basic rule, higher ratios are better as they represent higher ability to pay. Although excessive liquidity may indicate too much investment in current assets, this indicates lower risk of technical insolvency, but may lead to lower profits as investments in current assets are not as productive as compared to fixed assets.
Now, I will present the activity ratio analysis for Public Bank and Bank Islam from 2021 to 2025. Activity ratios measure how efficiently a company utilizes its assets and manages its operations to generate revenue. In this analysis, we will focus on four ratios: the accounts receivable turnover ratio, average collection period, fixed asset turnover ratio, and total asset turnover ratio. First, in the accounts receivable turnover ratio, which is calculated by dividing sales by accounts receivable, this ratio measures how efficiently a company collects payments from customers. A higher ratio indicates faster collection. From 2021 to 2025, Public Bank maintained stronger and more consistent performance than Bank Islam. Although Public Bank's ratio fluctuated between 5.7 and 7.3 times, it consistently exceeded Bank Islam's ratio after 2021. Bank Islam started with the highest ratio of 8.6 times in 2021 but experienced a significant decline before recovering slightly. Overall, this suggests that Public Bank managed its receivables more efficiently throughout most of the 5-year period. Next is the average collection period, which is calculated by dividing accounts receivable by sales and multiplying by 360 days. This ratio shows the average number of days required to collect payments, where a shorter collection period is preferable. Public Bank maintained a relatively stable collection period, ranging from 50 to 63 days. In contrast, Bank Islam experienced greater fluctuations, increasing to as high as 81 days in 2023 before improving. Although Bank Islam had the shortest collection period in 2021, Public Bank demonstrated more consistent and effective receivables management over the 5 years. The third ratio is the fixed asset turnover ratio, calculated by dividing sales by fixed assets. This ratio measures how efficiently a company uses its fixed assets to generate revenue. Both banks showed continuous improvement throughout the period. Public Bank's ratio increased steadily from 14.81 times to 32.53 times. However, Bank Islam recorded even stronger growth, increasing from 13.87 times to 29.36 times and surpassing Public Bank from 2023 onwards. This indicates that Bank Islam became more effective in utilizing its fixed assets to generate income during the later years. Finally, the total asset turnover ratio is calculated by dividing sales and total assets. It measures how efficiently a company uses all of its assets to generate revenue. Both banks recorded relatively low but stable ratios, which is common in the banking industry due to their large asset bases. Public Bank consistently maintained a slightly higher ratio, improving from 0.04 to 0.05 times, while Bank Islam improved from 0.03 to 0.04 times. This suggests that Public Bank was slightly more efficient in utilizing its total assets to generate revenue. In conclusion, Public Bank demonstrated stronger and more consistent performance in managing receivables and utilizing its total assets. Meanwhile, Bank Islam showed greater improvement in fixed assets utilization over the 5-year period. Overall, Both banks improved their operational efficiency, but each displayed different strengths in managing their assets.
Now, I'll present the comparative analysis of the profitability ratios between Public Bank and Bank Islam Malaysia Berhad from the period from 2021 to 2025. Profitability ratios are used to measure how effectively a company generates profit from its operations, assets, and shareholders' equity. In this analysis, we focus on four ratios: operating profit margin, net profit margin, return on assets, and return on equity. So let's start with the first one, operating profit margin. Public Bank recorded a higher operating profit margin than Bank Islam throughout the 5 years. Its operating profit margin increased from 37.54% in 2021 to 41.21% in 2022, mainly because the higher interest rate environment allowed the bank to earn more from its loans before funding costs increased. However, the margin declined to 33.6% in 2023 and remained relatively stable until 2025 as the deposit costs and operating expenses gradually increase. So, on the other hand, Bank Islam operating profit margin showed a continuous decline from 26% in 2021 to 17.3% in 2025. This suggests that the bank faced greater pressure on its operating profits, likely due to higher funding costs and increased competition within the banking industry. Overall, Public Bank demonstrated stronger operational efficiency in generating operating profit. Moving on to the net profit margin, Public Bank once again outperformed Bank Islam during the entire period. Although Public Bank net profit margin declined slightly from 29.2% in 2021 to 25.1% in 2025. It consistently maintained a higher profit margin. This indicates that the bank was able to control its expenses effectively while continuing to generate strong net profits. Bank Islam also experienced a gradual decline from 19.65% in 2021 to 13.1% in 2025. This reflects lower profitability after accounting for operating costs, financing costs, and taxes. Overall, Public Bank showed stronger profitability and better cost management than Bank Islam. Next is the return on assets. Public Bank maintained a stable return on assets of around 1.24% to 1.32% throughout the 5 years, showing that it consistently used its assets efficiently to generate more profits. In comparison, Bank Islam recorded a lower return on assets, fluctuating between 0.54% and 0.67%. Although the bank remained profitable, its assets generated lower returns than Public Bank. This suggests that Public Bank was more effective in utilizing its assets to create earnings. Finally, let's look at the return on equity. Public Bank maintained a stable return on equity of approximately 12% throughout the study period, indicating that it consistently generated attractive returns for its shareholders. Meanwhile, Bank Islam return on equity declined from 8.35% in 2021 to 6.9% in 2025, suggesting that its ability to generate returns from shareholders' investment weakened over time. This shows that Public Bank provided stronger value to its shareholders compared to Bank Islam. In short, Public Bank consistently performed better across all four profitability ratios. It demonstrated stronger operating efficiency, maintained higher profit margins, and generated better returns from both its assets and shareholders' equity, although Bank Islam remained financially stable and continued to grow during the 5-year period. Its profitability ratios were generally lower than those of public banks. Therefore, based on our analysis, public banks showed stronger overall profitability performance within 2021 to 2025.
Next, I will be presenting the leverage ratio analysis for Public Bank and Bank Islam from 2021 to 2025. Firstly, leverage ratios measure how much a company depends on debt to finance its operations and whether it can meet its long-term financial obligations. These ratios are important because they help investors and lenders evaluate a company's financial risk and stability. The first ratio is the debt ratio, which is calculated by dividing total liabilities by total assets and multiplying the result by 100. This ratio shows the percentage of assets financed by liabilities throughout the 5-year period. Both Public Bank and Bank Islam maintained high debt ratios, meaning that most of their assets were financed through debt. Public Bank's debt ratio remained relatively stable, gradually declining from 89.32% in 2021 to 88.88% in 2025. Meanwhile, Bank Islam consistently recorded a higher debt ratio ranging between 91.86% and 92.44%, indicating a greater resilience on debt financing. However, both banks showed stable capital structures over the years. Next is the debt to equity ratio, which compares total liabilities to shareholders' equity. A higher ratio means the company uses more debt relative to equity. From 2021 to 2025, Bank Islam consistently recorded a much higher debt to equity ratio than Public Bank. Bank Islam's ratio ranged from 1,129% to 1,222%, while Public Bank's ratio declined from 857% in 2022 to 799% in 2025. This suggests that although both banks rely heavily on debt, Public Bank gradually reduced its leverage after 2022, whereas Bank Islam remained more dependent on borrowed funds. The final ratio is the time interest earned, or TIE ratio, which is calculated by dividing EBIT by interest expense. This ratio measures a company's ability to cover its interest payments using its earnings. However, it is important to note that this ratio has limitations when applied to banks. Since accepting deposits and paying interests are part of a bank's normal business operations, many analysts do not rely on the TIE ratio for banking institutions. Even so, based on the calculations, Bank Islam consistently recorded a stronger interest coverage than Public Bank. Bank Islam's TIE ratio declined from 7.83 times in 2021 to 4.11 times in 2025, but it still remained well above Public Bank's figures. Public Bank's TIE ratio stayed relatively low throughout the period, ranging from 0.95 to 1.53 times, suggesting a more limited ability to cover interest expenses using operating earnings. In conclusion, both banks maintained high leverage throughout the 5 years, which is common in the banking industry. However, Public Bank demonstrated a more stable and gradually improving leverage position with lower debt ratios and a declining debt to equity ratio. On the other hand, Bank Islam relied more heavily on debt financing but maintained stronger interest coverage despite the declining trend. Overall, Public Bank appears to have a more conservative financing structure, while Bank Islam operates with higher leverage but a greater ability to meet its interest obligations. Thank you.
To conclude our analysis, both Public Bank and Bank Islam demonstrated the ability to grow and remain profitable throughout the period from 2021 to 2025. This shows that both banks were able to expand their asset bases and maintain financial stability despite changes in the economic environment. However, based on our ratio analysis, public bank consistently recorded stronger performance across most financial indicators. It achieved higher profitability ratios, demonstrated better operational efficiency, and generated stronger returns from its assets and shareholders' equity. In terms of liquidity, public bank also maintained a more stable liquidity position throughout the 5-year period, although Bank Islam continued to maintain healthy liquidity levels and maintain financially sound. Overall, while both banks showed positive performance and financial resilience, Public Bank emerged as the stronger performer during the period under review due to its ability to manage resources efficiently, maintain stability, and deliver consistent returns. With that, we have come to the end of our presentation. Thank you for your time and attention.